This discussion will be led by the moderator, Natznet Tesfay. So please, a round of applause for Natznet as she makes her way to stage. She will be joined by Kang Kaiyu. A round of applause, please, for Kang Kaiyu. Haytham El-Maayergi. A round of applause, please. And the final place will be made up by Fathima Hussain. A round of applause.
Thank you. And we appreciate the opportunity to have this critical discussion today. To put it into context, we want to shorten the horizon that we're looking at. We're looking at the medium-term outlook to the 2030, to see this as a critical catalytic period for Africa's energy investment. The outlook from a macro perspective is very promising, with steady growth underpinned by strengthening trade, which is quite unique in the global environment, leading to a significant demand increase for energy infrastructure. There's a need for over $200 billion estimates of energy financing to come in, and Africa's only receiving a fraction of that today. So I have an esteemed panel of leaders from development finance, M&A advisory, and Pan-African banking that will help us dissect what are the bold and actionable strategies that we can pursue in order to unlock this capital and ensure that we're attracting what is needed to spur us forward. We have a trimmed-down panel, so we're going to get right into the discussion, and I will introduce each of the speakers as I prompt you to start and contribute to the conversation. I would like to start with Haytham from Afreximbank, and where you lead the Global Trade Bank. Can you give us a perspective as to how this Pan-African bank is approaching energy financing and what you think is quite unique in the way of facilitating greater investment flows?
Okay, energy is a big thing for us. We're a $40 billion multilateral, and oil is a significant interest and focus for us. Not sure if the audio is heard.
Are we able to hear Haytham?
I think the mic is not working. Yeah.
Here we are, yeah.
So, it's a big part of what we do as multilateral, but also we're not giving it a focus on a specific area. We're trying to distribute our support across the different parts or personas of oil players, whether it's upstream, midstream, downstream, traders, FI playing in this, or even transitional energy. And we're trying also to make sure that we get creative when we offer finances, not just financing. If you see upstreams, for example, how we do reserve-based lending, or it was offtake, how we can do vendor finance. We did some couple of innovative solutions where the relationship between the refineries and upstream, where we use guarantees instead of FX going back and forth, and even help them in acquisition. So for us, it's very critical. But to your point, as a multilateral, it's getting even stronger now as we are unifying our efforts. We have the Alliance of Multilateral Financial Institutions of Africa, where we're trying to come together to be able to carry larger deals. And I think there's a lot of emphasis on how governments can support their African bankers. The more they put capital and liquidity, the more we can be creative, leverage it multiple folds back to those countries. And as you heard lately, we're looking on the long-term side, where we're looking at the Africa Energy Bank piece and how can we do a sustainable financial body that will carry the Africa demand to the future.
Quite extensive, and just giving us a high-level overview of how you're catalyzing this. I'd like to bring Kang from the China-Africa Development Fund, who's recently moved to South Africa to take up a position as Deputy Chief Representative. When we look at the CAD Fund, it's quite notable that last year there was a bold pledge made in terms of renewable energy investment across Africa. So considering that focus, what is your role in putting action to that pledge? And how are you approaching it to ensure that it's a balanced portfolio between large-scale utility and small-scale distributed energy?
All right, thank you, Moderator. And yes, as you mentioned, clean energy cooperation has long become one of the key themes for CAC, the China-Africa cooperation, and remains one of the most important things we are looking at from CAD Fund's perspective. So we have already invested, or we are just in the way of promoting some investment in South Africa, in Ghana, in Zimbabwe, and in many other African countries about the solar PV power stations. That we're also exploring some wind power collaborations in countries like Namibia. So as the first and largest equity fund established by Chinese central government, back in 2007. Catfund has been following the announcement, as you just mentioned, there's 30 new clean energy projects at last year's FOCAC. So we instantly established a 5 billion Chinese yuan green fund for the green industrial chains in Africa. So the initiative aims to support more Chinese companies to invest in clean energy across the continent. In this project, I think it's not only the large-scale utility-scale power stations, but also we are looking at the opportunities to invest some off-grid, mini-grid scale power plants, like even captive power plants. Last week, I was in Zimbabwe and Mauritius. I led my team to explore the chance that we could do some small-scale, not utility ones, small-scale power stations for the local factory and the mining projects. So we're also exploring some university campus in Nairobi to build the solar PV roof for them. So I think that shows how Catfund value our corporate social responsibility, and we actively encourage our Chinese and the local partners to do their job in the ESG commitments.
It's quite encouraging. So investing in the need today, but also into the development of skills and talent going forward. We have a picture of how public capital is approaching this existential need. If I can bring in Fathima from Standard Chartered, where you're looking at managing the oil and gas corporate finance, so giving us a sense of what the private sector is thinking about. What do you feel has been most significant when you're looking at the opportunities to invest within Africa, but how does that compare with the global landscape, more importantly?
Thanks, everyone, and good afternoon. So actually, I have a wider remit. I don't just look at oil and gas in Africa. I'm sort of looking across the energy value chain as well. And I've been covering Africa for a very long time, over 20 years. Certainly, we've seen a lot of change in the landscape around financing energy globally, in particular oil and gas over the last few years. What we're seeing is, there's a lot of opportunity globally. There's a lot of money available to finance oil and gas and energy globally. And I think what we're really seeing is a lot of that capital is moving actually to the more developed markets. Some of that wave has been, a real push to support the ESG and energy transition. So we've seen a wave of financing in the European markets, for example, particularly in renewables, and that was certainly happening also in the US. More recently, we're seeing a wave of oil and gas related financing, LNG projects, again, with a lot of capital moving into those developed markets. Africa, rightly or wrongly, has always suffered with the perception of higher political and country risk. And I say rightly or wrongly because actually I don't think people are fully baking in maybe country risk in more developed markets, quite frankly. But the reality is that capital is following, capital follows investors. Investors are looking at their risk-adjusted return and where they see the best opportunities for their investments. We do, as a result of that, I think, certainly in the African market, we've had to be a little bit more creative in terms of how we can draw liquidity into projects. And that means really tapping into risk-sharing structures, working with the likes of Afrexim, CAD Fund, other DFIs, multilaterals, equity-type instruments, but really being a little bit more creative because a lot of the sort of standard commercial international capital markets is getting drawn elsewhere beyond Africa, unfortunately.
That relative risk perception is quite prominent, and it's been there for some time. What's interesting is when we look at our own political risk scoring within market intelligence at S&P, we see a convergence in a marginal improvement in steady over the last 15 years across emerging markets and a deterioration in OECD markets. So it's a big question that I imagine we're going to be revisiting as we're thinking about how to attract investment into these dynamic economies across Africa. But we have a blended panel, which it's a partnership that we're taking the audience through. And you mentioned blended finance as a mechanism to offset that risk perception, or at least to share that risk, so that you can have a distribution within the respective partners' risk appetite. If I can come to you, how do you approach that, and what do you think is going to be pivotal over the next 2 years in terms of accelerating energy investment?
I mean, I think from our perspective, and being deeply involved on supporting projects in the African continent, you know, we are big proponents of blended finance. It's partnership between private and public sector, and working with the DFIs and the multilaterals to come up with financing instruments that first and foremost are you know, utilized to support projects that are really going to be instrumental in developing a lot of the sectors and countries in Africa. But secondly, works in the context of, you know, of a bank like ours and other in the private sector, where we need to deploy capital in, you know, in as efficient a way as possible. And that's where the partnerships with the DFIs and multilaterals are really important, because what's important is how we can get the risk rating improved and the capital deployed more efficiently through a risk-sharing mechanism. So quite often, rather than direct lending by DFIs or multilaterals, it's covered or first loss guarantees. It's you know, from a DFI perspective, it's catalyzing private sector investment. From our perspective, what we really want to do is we have the capital we want to deploy. We want to deploy it at scale. And that's the issue at the moment in Africa. It's not able to be deployed at scale because everything takes quite a long time to try and make everything work. Scalability and partnerships that can be rolled out more efficiently is really important.
And if I come to Kang, if you can give me a final reflection as to how you are approaching this challenge from the CAT perspective.
Yes, that's a good question, because I think from my perspective, we always place a very high priority on the investment in the clean energy sector. I think this commitment is not just saying that we do mere financial investment. We also actively encourage companies with within China's clean energy industry chain to gradually engage in the production capacity cooperation here in Africa. Our objective is to gradually bring the made for Africa to made in Africa. And in this process, I think we attach great importance to the transfer of energy technologies and our expertise, our experience back in China to Africa. And we also do our equity investment and debt investment also, because sometimes I think Standard Chartered of some commercial banks, so you have the ability and you have the capital to help equity investor like us to make a project bankable. But sometimes I think also cat fund can use our capital advantage to make a blend or mix the investment together. And for example, I think last November, one of our teams went to do a site survey in one of our solar PV stations in South Africa, and they gladly see the local, all the people conducting the maintenance within the power station is just they are all from the local community, and we will do more to make such kind of capacity cooperation work in the future. And I think I'm so proud to see that this specific solar power station was financed by them. I think this is very good
tangible example that
yes.
You're providing the audience, and
yes.
one where you were giving examples just generally in terms of the approach of CAT of latitude, so you have the flexibility to respond to the need or the project at hand.
Yes.
And I know that Afrexim is pioneering that, ensuring that there is ample flexibility so that you can be agile, quite dynamic in the facilities that you provide. But if you could leave the audience with some core solutions, or at least one call to action, if you will, considering you're the Pan-African representative on the panel, and we're thinking about financing growth. If you're leading that charge, how would you mobilize this room?
Yeah, so let's face it, we in Africa, due to our rating system and the way our financial institutions are rated and corporates, we pay per kilowatt more than anywhere in the world because it costs us more to do a power station to dig for oil, giving the rating system. And if you look at this, despite the fact that we don't have banks crisis, banks melting like we've seen with the Lehman Brothers, the Silicon Valley, the Swiss market lately, we still don't have the letter A's widely used in Africa, causing us to pay more. And hence, for all of us, we need to think of how are we mitigating pricing risk correctly. So we work a lot of our customers, for example, to repack the risk according to investors' appetite, wrap it with insurance, wrap it with guarantees. We do blended. We're launching our concessional finance window now to mitigate this. We're doing a lot of on-lending guarantees. So we're trying to work with international financiers to take the risk of Africa for them, to trying to mitigate the effect of how Africa is rated, viewed, which is perceived at a higher risk than what happened in the future to them. My view is most of these projects need to, as I always say, go to the doctor early, work with their banker to find the right model to start before they start to contemplate further in the projects. And again, my plea to all countries that they need to start to, we need to have stronger, bigger African banks, not only multilaterals, because our dreams are too big for the banks that available in the continent now to carry. And if you look at Asia, Europe, and all of the other developed market, we will see the size of, relative size of banks that they carry the projects with compared to here. So this area has to be fixed in addition to a lot of this gap that we hear about in financing oil. Is not actually a gap to grab now because there's a lot of work that needs to be done in project preparation, the bankability of this project. So a lot of the projects that we are dreaming of still between the dream and becoming bankable and financeable, it's a gap. And I think we as multilateral invest a lot in preparing for these projects, move it to the project finance area in a healthy way. But I think a lot of work needs to be done in a large number of projects. You look at the gap is really large, but you look at the active projects that are being on the market are not as large compared to the gap. And the only difference is because they're not prepared and ready to be in the market. And it's a stage that a lot of people struggle with.
So the partnership starts earlier, upstream, if you will. It requires the project scoping, origination, if we're thinking about it from that stage, so that it has the strongest chance of being successful from a blended financing perspective.
Yes.
The conversation here reminds me of the old adage, if you want to go fast, go alone, but if you want to go far, and if you want to scale, to Fathima's point, we have to go together. Can you please join me in thanking the panel for this special shot of insight around financing Africa's energy growth?
Fantastic. Thank you.